Okay, so this is Iain Bratt speaking. I have with me Ken Smith. Say hi, Ken, please.
Hi, Ken, please. Oh, hello, Ian.
It's good to hear you, my friend. Appreciate your sense of humor, as always. So what I'd like to do today, Ken, is to talk about the wealth management product. And we have here a situation where we have a test account that I've created, and we're going to be in the back office, or somebody's logged on. They've clicked on using their username and their password, and they've come into their system here. And the wealth management login button is the third one down. We already talked about free analysis. At any time, somebody can repeat a free analysis in case their circumstances have changed, and they can personalize it to themselves. They'll click on the wealth management button, and it'll come up when the first time they go in. There's a user agreement, and we're able to, as always, agree. As anybody that uses software will know, we are expected to click the agreement for the software. The very first thing that we're going to be doing here is to create a profile. We're now using the product properly. And we're going to be talking about a wealth acceleration account. Remember, we're looking here not just to eliminate debt, we're looking to accumulate wealth. So the first thing that we're going to do is to actually create our wealth acceleration account. And this is cool because this could be a lock if you have a line of credit. Most people don't have a line of credit, but if you happen to have an equity loan or whatever else that you want to leverage capital that's available to you, you can use that with this software. But in this particular example, I'm just going to say somebody's got a bank account. Okay. Now, here's one thing that you're going to notice. This is our bank account number one. It could be with whatever bank we choose. I'm not going to name the bank. I'm not going to put a routing number or an ABA number in there. I'm not going to put an account number or the branch number or anything like that, because that's proprietary and we don't need that to be there. We're just going to have a bank account here. I'm going to say there's a balance in there of $4,000. Okay? It's not an interest-bearing account. It's just a bank account. It's my main current account. It's my main checking account, and that's the one that I use. And now what I would say to you is, you can see here that there's question marks all along. Help is available to you, and you can have a look and get a prompt if you're not sure what it's expecting you to put in there. And I'm going to hit save because that's my main bank account. I'm the type of person that probably saves some people might say too frequently, but that's my choice. I just like to save stuff regularly. We can edit and we can discard. And so we've got a bank account there, our main wealth acceleration account. I can add more bank accounts if I want to. I'm going to make this a small and simple example today, but if I got multiple bank accounts, I could add those too. Let's talk about a couple that are living together and they're enjoying life. We'll have a husband whose name is Hubby. Okay, and let's say that this is his income. Let's say that he gets paid $3,600. Okay, this is his take-home pay. Now we can set the frequency of how regularly he gets paid. I've got that set to monthly. It could be twice a month, weekly, every 2 weeks, quarterly, annually even. We'll just say that it's monthly for the sake of argument. And let's say he's also got, let's have him paid at the beginning of the month. That's fine, isn't it? He's been in the job a long time. I'm not going to give him a start date. And he expects to be there a long time, so I'm not going to give him an end date either. And we'll hit the save to say he's there. I'm going to add another one in here. I'm going to put his good lady wife. Okay. And let's say she's pulling in 48. No sexism here. She's also paid monthly. Let's have her paid. This is a real life example here. Let's have her paid in a couple of days' time on the 19th. Now you'll also notice periodically you'll see this upload receipts. You can upload a PDF or a JPEG of a document. Helps at tax time. So we've just been able to create a bank account, and we've got two sources of income coming into the household. Okay. Let's now talk about, we've got money, that's money coming in. Let's talk about money going out. Okay. First thing that I want to do is I want to put some consumer debts in. We had some debts earlier on that we were talking about. The payments are going to come out of their bank account. We could make an override in terms of the priority. We could choose to prioritize higher and lower if we wanted to. And I'm just going to put in here that they've got car number 1. And let's say that car, expensive German car maybe. Let's say that that's $25,000. Interest rate, 5.99%. Total payment is $483.20 on that. Pay that monthly. Let's say there's a payment due on that 5th of the month. I'm going to leave the start date blank. I'm going to leave the end date blank as well. We could put deferments and the like if we wanted to. I'm going to let this in the computer work its magic and take care of the algorithm itself. And I'm going to save that. Okay, I'm going to add another debt. Let's put another car in here, car number 2. You still with me, Ken?
Yes, sir.
Let's say the balance on that is $10,000. We'll give that an interest rate of just under 10%. And we'll make the payment. Now, if you say that in your part of the world, hey, Ian, these payments aren't realistic, then that's okay, because at the end of the day, math's math. You know, at the end of the day, it's like putting numbers into a calculator. It will work on the principle of the arithmetic. Okay.
Yeah, it's an example. Absolutely, Ian.
Yep.
No...
So let's say they got some credit card debt. We'll give them a Visa card here. Let's say they got 7,500 on that.
I'll swap them.
Okay. Well, they're getting a good interest rate. I'll give them that. And they're just whittling away at that. They're just paying 175 off, and that's going out monthly. Let's have that go out on the 12th. I'm just grabbing dates at random.
Sure.
Then we'll save that. What's the situation with student loans down under? Are the kids coming out of college and university with debt?
Not that I know of, but it's been 45 years since I went to college, so it's a bit of a worry. But I think it's more that the parents borrow the money against the house and pay it out. I don't actually know. There's a thing called a HEX debt,
right?
Which is a government loan. Yeah, there's something like that.
Well, certainly in North America, and I guess even in the UK these days, you know, student fees and student debts have become something of a political issue. So here we are. We've got their debts loaded up there, and you know, there's a fair amount there. You know, there's over $50,000 in debt there. Let's talk about their household expenses. Okay, now, because we're on a recording here and you and I are doing a demo, you know, fairly quickly in between us, what I would point out is if I was doing this myself, and here's one I prepared earlier, as they used to say on the cooking shows on television, we could be very specific and make a list of all the expenses that we have, and you know, here's an example of, you know, property taxes, homeowner fees, electricity, you know, water, sewage, phone, groceries, repairs, cable, all the things that we might have in from a household expense, how much we're going to be paying, how frequently we pay them as well. Is this a weekly expense? Is this a monthly expense? When's it next due? So the system could be that analytical, and there is no limit to the number of items that we could put there. What I'm going to do, I'm going to play a little bit of a game here. Let's say that these people have some sort of card, okay? And let's say that they put all of their household expenses on the card, purely and simply for this example. Now, I happen to know that there's a couple of people that do actually do this, because they then they'll get all the points and the cash back and all that kind of stuff. But let me just put one expense, which is going to be their household overheads, let's call them. And let's say that goes out on the 12th of the month, I suppose. Okay. and we'll hit the save button for that. Now let's give them a mortgage as well. This is their house. So I'm going to say that's house. Now again, you can put bank names in if you want to, but from a security perspective, let's say there was a jeopardy or a compromise situation where information was available, and we know that at the end of the day, nobody's hacker proof.
Correct.
Why give them the information? So let's say that their prevailing rate at the moment is 5.5%. Let's say that's over 30 years. Okay, and let's say that their total payment is $1,075. We'll have them pay that monthly. Let's have that go out on at the 9th of the month or something like that. On 7th, as good as any, and we'll hit save there. Now let's just do one more thing here. Let's save and continue with that.
I have a question, Ian.
Please.
Yep. What if you had several investment properties as well? Could you repeat those same?
Absolutely. You can put as many as you want to in there. I'm going to give them a little bit of an investment. That's a great idea. Let's say that they've just got, I don't know, a small interest-bearing account. We'll call it savings. Okay. Yep. And let's say that savings account's got just over 2,500 in there. Let's say
I'm nearly tempted to swap them again.
Well, let's just give it 1%. All right. And let's say they're, being frugal, putting money away for a rainy day. Look at them, they put $170 away a month. Okay. Yep. And we'll have that go out on the 1st. Why not? All right. So let's have a look and see what we got here. At the moment, they've got discretionary income of $2,300, which you might say is a little bit high. That they've got a relatively modest income. They're living well within their means, because at the moment, this couple that we've got here have got $2,300 difference. We can go back and play with that. We can go back and change that if we wish. In fact, let's do that. Let's make it a little bit more real. But let's bump their monthly expenses. Let's edit that amount, and let's up that to 42. Let's say. And that's the beauty of the software. We can make changes at any time, and do whatever we want to do. Okay.
Can I ask
Sure.
a question,
Please.
just in the interest of total clarity?
Yep.
As we are, the monthly cost of the software.
Yep.
Is that taken into account within this, or would we put that in another field or something?
That's a great suggestion. Now, for me, I'd actually got subscription down there as a line item when I was doing it individually, and I'm going to pretend that, for the sake of argument, that it is in that expense there, in that total. Now, at the moment, the difference between their money coming in, their discretionary income versus expenditure, they got $1,600 left over. Now, what I can say is, allowing for some conservatism, let's say that they're going to make the decision, listen, I don't want to be completely up against the buffer here. For computer purposes, I'd like a little bit of space. So just apply 1,500 of the 1,600 to my calculation when it does the calculation here. And I'm telling it here to go ahead and calculate the plan. And this is where the magic happens. This is where the algorithms go behind the scenes. I want to tell you, Ken, I spent 4 years, my 4-year college is in accounting. I'm pretty good with spreadsheets. I've used most financial software products. What this does behind the scenes, I can't do with Excel spreadsheets. So this is the results. Here we have a main dashboard for our couple here, and we're in a tremendous situation here because
wow,
I think we got a small error there because I haven't put the mortgage in correctly. My apologies. I'll have to go back and edit that financial. It just goes to show that we can work through on here Yep, I hadn't put the interest rate on the mortgage. Now, if anybody knows of mortgages that don't have interest rates, I'm very interested. I'd put the interest rate there in the wrong place. A mortgage with no interest rate is called mom and dad, isn't it?
Something like that. but there's always emotional attachment to that one.
I'm sure there is, my friend. It's probably cheaper to lend the money, right?
Absolutely.
So let's start that reconciliation process over. And that
It
shows
just lets the listeners know that we're all for real here.
Well, absolutely, and it shows the flexibility of the system as well in terms of it being able to go ahead and make the calculations. Okay, so that's much better here. So what I'm seeing here is that we have a mortgage which is really good here. Let's paint a picture here and look at some reports. So this is the main dashboard. It says the current debt, the 175 plus all those consumer debts. It's saying we could pay this off in 9 years. That's all of the debts, and it's saying that we could save $133,000 in interest, which is pretty darn good.
Wow.
And it's also saying that over a 30-year period, if this couple were to be in a frugal position, based on an investment which is close to the mortgage, that they could almost, over a 30-year period, accumulate, well, $1.9 million, which is absolutely phenomenal. Again, it's mathematics, okay? And here's how the software works. It looks at the transactions that are about to happen. And can you see here it's saying, okay, we recognize we got a student loan payment. We recognize we got the wife's salary coming in on the 19th. And it's actually making a recommendation, pay a lump sum off car number 1. And then it's saying, okay, I've got the car payment on car number 2. I've got my savings payment on the 1st of December. Hubby's salary is going to come in. I'm going to make the regular normal payment on car number 1. I've got my house payment. I've got the visa payment. I've also got that the household expenses, if it's in one lump sum there. I'm going to make a student payment. And then it's also saying, make another lump sum payment about the car. So it's aggressively gone after the car loan. And that's purely and simply based on the way that the software is working. In fact,
the higher interest rate on that car.
Well, the balance outstanding plus the funds that are available, the principal that's outstanding, the interest rate, and it's saying out of all your debts, that's the one that you should unload the fastest. Now, the price is $34.97 a month, and we've already saved $2,300 in this cycle of November. Well, going to the beginning of January. So, is it value for money? Absolutely, it is. Okay, let's look at the reports here. Let's get into the nitty-gritty. Let's look at the wealth acceleration. No, let's look at the income and expenditure. That's a good place to start, because we said that the husband and wife between them, they've got $8,400 coming in a month. Okay, and we've also said that from an expense perspective, they've got $4,200 is their living expenses, which I'm paying off on the card, plus all the other debts. So they're committed to $6,784, which means that they've got this discretionary income of $1,600. And that's where the magic lies. It's being able to say, okay, what can you do with $1,600 a month? Well, you can go to the pictures regularly. You can eat out. And I'm not saying that we should be totally frugal and live in a monastery, but what I am saying is that we have an opportunity to reduce the debt. And so let's have a bit of self-discipline now, and then in later life we can be in a position where that mortgage goes away in particular, and the debt goes away, or more importantly, as we maintain our wealth to debt ratio, we have an opportunity perhaps of upgrading to other things. Let's look at the mortgage, because that's a great place to start as well. Look at this traditional mortgage. The traditional mortgage is going to take 30 years to pay. Okay, the wealth accelerated, we're in the first period of time, first couple of years, it's about the same, but then we can make some dramatic changes. And in particular, the first particular period there, we're attacking the consumer loans of the cars as opposed to the house. Then once that's taken care of, then we can go and bang on the house, and let's get that house paid off very, very quickly in 9 years as opposed to 30 years. Showed this software to my wife. Of course, she said, because we'd been in our house 13 years, and the question was, well, why didn't we do this 13 years ago? And she's absolutely right. And she's absolutely right, of course, because at the end
For
of the
sure.
day, the traditional method, you're going to pay $182,000 in interest as opposed to paying $55,000 in interest. I'll let that sink in for a moment. 55,000 compared with 182.
Oh yeah, that it's an amazing saving. It's when my wife comes back from the shop, she always says, "Hey, look at this great dress, these great shoes. I saved like $200." And I go, "Well, give me the 200." And she says, "No, you don't understand. This would help us."
You know, the other thing that we have to bear in mind is when we're paying off a normal mortgage, the first few years, you know, in the first year, you're going to pay 9,500 in interest, but you're only going to reduce the balance by 2,100 because in the initial payments, you're really dealing with the interest more so than the principal. And so on the left-hand side, we've got the traditional method. And like I said, I appreciate that the interest rate changes, and if that's the case, then we go into the software and we give it the current rate.
Correct.
So on the left is the traditional method over 30 years. On the right is the wealth accelerated method, which is very attractive. I'm sure you'll agree with me.
Oh, amazingly so.
Okay, let's have a look at the consumer debts. Now, this is where it's interesting too as well, Ken, because we've got these four loans, we've got the payments, we've got the interest rates, and we can see here how even though car number one doesn't have the highest interest rate, in fact, it's got the lowest at $599, it has the most outstanding, and so factoring the four different loans that are there, the computer said, okay, the best thing for me to do here is to go for that particular loan swifter. And then after that, and of course you're making payments at the same time, it's also saying, well, let's look at the other car loan. Let's also look at the credit card, and let's also look at the student. But the point being is it's paying it off much quicker by following those examples. And as we saw, it was the car loan that in this particular set of circumstances that it's chosen to attack. And here's another thing I'd point out, Ken. Somebody might be saying to themselves, why do I need to do, if I do it once, that's great, and that's all I need to do, right? So my suggestion is no. The reason you pay the monthly subscription is because every month's going to be different. Even if your salary is fixed for the next year, your expenses are not going to exactly be the same. Things change, circumstances change. So it's important to have a tool that is a living, breathing piece of equipment as a tool for you to use. Let's talk about the mortgage. What we're saying here is if that mortgage is paid off after 9 years rather, and if we were to get a similar return, and this is an illustration, okay, but if we were to get something which was of a similar yield, by putting that $1,000 a month away, we'd be able to see a tremendous growth. And you'll notice that this is 30 years, and it's saying nothing in the first 9 years because you're still paying off the loan. But if
Correct.
it's saying, okay, if we can make a regular monthly contribution over the balance of the 30 years, that's a substantial sum of money that could be saved. And there are people doing this, Ken. There are people doing it. We also, from a more modest perspective, we put $170 away a month. If you remember, in that savings account that was only bearing 1%. But even that, over a 30-year period, is 75 grand.
Wow, that's yeah. You don't even think like that, do you? And people, and I think a friend of mine once said to me that you either get wealthy or go broke $1 at a time.
Right. And again, we have the wealth acceleration account there. Looking at the, we want to be in a position where the graphs are heading in that direction. And so here's what I'm saying. In the traditional method, you've got a mortgage that's going to take 30 years, and you're going to pay 100 together with the other loan as well. The consumer loans. You're going to be paying $192,000 in interest. Or we can make you debt free in 9 years, and you'll only pay 59. So that's the mortgage and the consumer debt. And so, as a snapshot, what we're saying here is, I mean, that's just tremendous, isn't it? The challenge that we have, in my opinion, I'm a father of three. My three kids are in their 20s. None of them were ever taught in high school how to manage money. And
No.
I've got one in her fourth year of university. Her sister's got 3 years of university. My son's already out of that scholastic program. None of them, even at college, were taught how to be responsible with money. It's something that's been left to mom and dad. And there are tools out there, ladies and gentlemen, and this is the best tool that I'm aware of, because it really does guide you all along the way, and provides direction. I want to show you, when you said earlier on to me, Ken, so we've got a dashboard, we've got a report section, we've got the edit personal section where we can set up our information. One of the things that I like here, you can set up your preferences. If I can be notified about any actions either on a daily basis or a weekly basis or a monthly basis. Let's say it's going to tell me to make an extra payment. I can either get a text to my phone, or I can get an email, or both. So it will actually say to me, based on the calculation, Ian, make an extra $400 payment on your car. I love that. I really do. It takes me about, I spend 10, 15 minutes a week just updating all the transactions, which isn't bad.
That's better than trading. That's better than trading shares, really, because you're dealing with what you've got, what you know, and you're being coached through it. I mean, for $40-some a month, it's making you at least as smart as the banks.
Well, if you're saving, whether it's $50,000 in interest, whether it's $100,000 in interest, is it worth 15 minutes a week? I think so.
You think so? That's the highest paid profession I've ever seen.
We have the reconciliation process, which is if we make any change in the data, hit the reconciliation. And one, as a tip I would give here, we had that long list of expenses. I'm normally put them in five or half a dozen at a time, and then I hit reconciliation. And in case there's a problem, reconciliation, which might be down to the timing of the, because you don't want to send it in negative, you don't want to send it overdrawn. So you want to make sure that the payment timing is correct. Now here's something that's nice. We can, if you want to, you can add more businesses. With your subscription, that is not just for one profile. You can have as many profiles as you like. If you might want to add a new business, maybe you've got a property rental business. Maybe you've got an MLM business. Maybe you've got whatever. Maybe you just want an account as a demo to show to people. You can create a new business under the business section and have exactly the same functionality repeated as many times as you want.
So husband and wife who either run a household together, or they ran their own affairs separately.
Yep.
They could use two profiles in the same subscription.
Yep.
How wonderful is that? I mean, how much? I mean, there's 100% saving in one go.
Right. Now add the MLM business, 200. Now add the property rental business, 300. Maybe put the kids on if you wanted to. But
yeah, beautiful.
Now here's something else I like. What if? The what if scenarios. I want to buy a motorcycle. I want to buy that big screen TV. And whether it's a one-off expense, so whether it's a new household expense, or whether it's just a one-time payment, you can add something in, run the calculation, and between it helps in the negotiation with the better half as to whether Harley Davidson's going to be in the garage or not. Or the boat, or the holiday, or the wedding for the kids that are coming up. We also have tutorials. We have a slew of tutorials of how to do various things. And then there are tools in there as well, the appointment calendar, the the daily task list and whatever else. So at the end of the day, what I'm saying to you here is that this is, in my opinion, this is one of the best financial products that's out there on the market. It has about a decade's worth of history. It's been used by certified public accountants, by realtors, estate agents. It's been used by investment financial planners and the like. And it normally retails for about 4,000 US as a one-time payment. And so the fact that we're able to offer it at the price that we do on a monthly basis is just tremendous, because it really does. It does exactly what it says it will do on the can. It accumulates wealth through reducing debt. Any questions, Ken? Or any comment?
No, it's an amazing product. It's certainly, and I've seen a lot of them, but over the years with slightly different functionality and so forth. But that gives you customization. It gives you functionality. It gives you like the what if, and it gives it to you easily. And what you were saying about negotiating with the better half. That the partner always has the last word, and then anything you say after that is the start of a new argument, right?
I've learned when to be quiet.
No, I know that I'm being a bit humorous about all this, but this is a good-looking product, and it certainly is a very, even if it didn't save you the kind of money that it saves you, it's still an inexpensive product to get the best handle on what you got, because if you didn't know this information, that'd be free. I get that, except it'd cost you a lot of money in mistakes. And honestly, rookie mistakes is what sends people broke and keeps families arguing over $300 a month. And I mean, this is going to save that, in the right circumstances, real easy. And to me, not knowing this sort of information, and even if you know it, but you haven't got it at your fingertips, I think it's a big mistake. So, I mean, really, thank you for showing it and explaining it to me.
What I'd say as well, Ken, is that there is budgetary software out there, and some of it's free to download even. And if you just want to track your income and your expenses, then by all means use that product. And I would rather people use that type of product than use nothing at all or just guess. What those products don't do, which is what our product does, is it's intuitive. Our product's going to make recommendations. Like I said, the algorithm and the calculation behind the scenes that's saying in this fluid movement, particularly as we're attacking that compound interest, the free products won't be able to do that. And that's where the magic lies. That's where we're able to make the huge savings in debts. Yeah, there are different ways to reduce a mortgage. I've heard people that make a 13th payment every year. Or they put an extra $100 or whatever else when they make the payment. And that's better than nothing. But at the end of the day, let's be in a position where we look at the difference between the money coming into the household, the money going out, and saying, what's the wisest way to use this? And let's enjoy life. And I got to tell you, the life's going to be a lot more enjoyable when you don't have any debt.
It's a click-by-click wealthy, wise uncle, isn't it?
Oh yeah, yeah, very much so. And I again, going back to the if we go back to the main dashboard at the top. Whoops, let's go right to the top here. Even at the top here, it's actually saying, today's the 17th, and if this was a real life example, it's saying in 3 days' time, make an extra payment against car number 1. That's the rich uncle who's old and wise saying, okay, Ian, out of all of your situations, and I know them intimately, that's the thing that you need to do next. Fantastic.
This is all, but there is a disclaimer on this. For the people who use this, have just got to be absolutely ruthlessly truthful.
Yes.
With their numbers.
Yes.
And they will get a result.
Absolutely.
That they probably will be happy with.
Absolutely. And again, at any time, click on the Edit Financial button, go to wherever you want to go, and we can make a change. Let's say we're going to make a change, and I don't know, it's just a payment. and it's going to be a monthly payment of, I don't know, $180. Okay, and I'm going to make that monthly. I'm going to make that payment on the 9th of the month. If I'd got a receipt, I could upload it. I'm going to hit save. It's now in the system. I can hit the reconciliation process. It goes back and recalculates. And I do like that idea of being able to upload a JPEG or a PDF if I wanted to. And it just went through and it made all the calculation changes and just took into consideration another item, which is great.
Yeah, it's reduced the. At the end of it, there, it's basically, notified you that you've got less money left to spend this month because you've already spent. It's beautiful. It's I mean, yeah. Thank you for the explanation on that. I mean, it's way and above and beyond anything that I kind of glanced over it when I first saw it and heard about it, and I really, said, well, yeah, this is maybe another one of those, but it certainly isn't, Ian. It's so deep.
Yeah. Now,
and
add that to the other offerings. Obviously, we have the power offerings in various areas, but most importantly, we've got that learning platform where we're applying the Six Sigma principles and learning. And so, at the moment, those are the three main product offerings. And as we speak with Jim Lubkin, and as we speak with Don Drury and Sandra. As well, we're in that situation where we're looking to add more and more products going down the road that meet the same philosophy, that we're making a difference in people's lives. And I don't want to say that as a trite statement. I think that's one that's perhaps been overused in our industry. But in reality, I think there's a harmonization here to improve lifestyle. And I'm just very grateful for the opportunity that I have to be associated with Six Sigma Social.
Yeah, all three of these initial products are, learning to find your way in life where nobody's taught you how, learning to use Facebook, which is the biggest communication platform in the history of the world, and then also being able to control either any money you have, any money you make, or any money you spend. I mean, that's a great grounding. It's a great platform that hundreds of thousands of people across the world just never had that rich, wise uncle. And I think that it's the best thing I've ever seen. I can, as a package, and knowing that the savings that are coming with, other utilities and other things that will come down the pike over the next 10, 20, 30 years, I mean, this is a no-brainer.
Absolutely. Well, my friend, thank you very much. I'm going to stop the recording now. It's been a pleasure. Thank you.